An interviewer last week said to me, well, what's the least important thing? I hadn't had that question before. The least important thing is the short run. Everybody's obsessed with what is going to be inflation over the next 6 months. What will the central bank do in terms of interest rates to fight the inflation? And will the changes in interest rates produce a recession? This is what everybody wants to know. And consequently, of course, what will happen to security prices in the next 6 months? And the answer is it doesn't matter. Those are all short-term considerations. It's all about the next 6 months, 3 months, 12 months, whatever it might be. Number one, we really can't know much about the short run. Number two, if we develop an opinion about the short run, we shouldn't have too much confidence in it. It's hard to get that right. Number three, nobody should change their portfolio wholesale in response to what they think is going to happen over the next 6 months. And number four, the next 6 months isn't what matters. My clients and your clients should be investing for the next 10, 20, 30 years. I think it's easy to make money in the markets. It's especially easy when the markets go up, and 7 or 8 years out of 10, the markets go up. So that's not a problem. I think the mark of the professional investor is the ability to make money with risk under control. Again, you can make money by abandoning risk, and 7 years out of 10 or 8 years out of 10, that'll work great. In the other 2 or 3 years, not having risk control will really cause serious damage to be inflicted. I think it's important to outperform the market when the market does poorly. If you establish your portfolio so that you will beat the market when it does poorly, there's a decent chance that you can't beat it also when it does well. You do better in the good years than you do badly in the bad years. And by the way, I don't think it's important to beat the market in the good years because everybody makes a lot of money, but then substantially above average in the bad years. The combination of the two will give you above average performance over the long run with below average volatility and risk. And contrarianism is very important. And basically what it consists of is understanding the excesses of investor psychology. And number one, not being part of them. And number two, taking advantage of them. 90% of what you have to know about market behavior, especially about short-term market behavior, is that in real life, things fluctuate between pretty good and not so hot. But in the market, investors go from flawless to hopeless. And nothing's ever flawless and nothing's ever hopeless. And what that means simply is that when people think the outlook is flawless, they're too optimistic and they're going to be disappointed. So you want to turn cautious at that moment. And when people think that the outlook is hopeless, things are never hopeless. And when pessimism is overdone and people think the outlook is hopeless, it's important to turn aggressive. So we do modify our stance between aggressiveness and defensiveness, but as I said, we never get in and out of the markets. That's really just too hard to do well. If you look at a chart of GDP over the years, it kind of looks like this. It fluctuates slightly. Our GDP grows about 2%, sometimes 3, sometimes 1. Rarely -1, rarely 4. So the fluctuations in the trends are modest. Now, if you look at the trend in company profits, it looks more like this. The fluctuations are more pronounced. Why is that? Companies are affected by the trends in the economy, but they have leverage. They have financial leverage and operating leverage. What that means is that when sales go down 2%, profits go down 20%, et cetera. So profits fluctuate considerably more than GDP. Now, if you look at a chart of the stock market, it goes like this. It fluctuates wildly. Investing is taking an interest in companies' profits. Why do the prices of investments fluctuate so much more than company profits? The answer is psychology. And, as I said before, investors go from flawless to hopeless and hopeless to flawless. And they overdo the good news and they overdo the bad news. You want to turn aggressive when everybody else is terrified, and you really want to turn defensive when everybody else is carefree. But those opportunities don't come along very often. We don't have profitable chances to do that very often. Most of the time, we're straight down the middle. And so why does everybody care about it so much? And the answer is, it's kind of like social media. It's all around us. People are talking about it all the time. The newspapers talk about it. The talking heads on TV talk about it. And everybody gets on TV and they said, well, do you think there's going to be a recession in 6 months? No, I don't think so. Yes, I think it's bad. Yeah, not too bad, but pretty bad. This isn't what matters. And people drive themselves nuts with these matters and they hurt their performance. Look at the markets today. The markets are well down and everybody's afraid about what's going to happen in the next 6 months. Second level thinking really is a matter of understanding you have to think at a different level than other investors. Other investors, on average, are going to make 9. If you want to make 10 instead, you have to think of something they haven't thought of. You have to know something they haven't thought of. You have to think at a level which is different, more sophisticated, not easy. And I have an English friend, Richard Oldfield, who wrote a book. I love the title, Simple But Not Easy. The first level thinker says, this is a good company, we should buy their security. Most people look at it and see the same thing. But the second level thinker says, it's a good company, but it's not as good as everybody thinks. So it's going to produce a disappointment. We should sell their securities, you see? And you're just thinking through to a new level. You're thinking through to the ramifications of what everybody thinks. It's simple to explain the goal. It's just not easy to do, but that's why there are superior and inferior investors. That's why some people have good long-term records and some people don't survive for the long term, because it's not easy. I would like each person who's listening to say to themselves, do you want to outperform or are you happy with average performance? It sounds kind of un-American, but I think in the long run, average is really good enough. And if you want to be above average, which is a reasonable goal, how will you do it? And since this is a competitive activity, you're competing against all the other investors out there, and you want to have a better record than they do on average, there has to be some advantage that you have. So I would like the listener to say, well, what is my advantage? And I think that to be a superior investor, you have to have what I call a knowledge advantage. You have to either know facts that the other person doesn't know. The goal is to make sure that everybody has the same information. Otherwise, it's inside information, which could be illegal. So it's hard to get facts that the other person doesn't have on a given company, or process them better. So the people in the audience should say, do I have some mental equipment that permits me to process the facts better? And clearly, in order to do that, you have to be an expert. Is it reasonable for me to think I'm an expert? It's great to have aspiration, but your aspiration should be based on some reality, which is, I know something the other people don't know. Is that a realistic thing to say? And if not, you should, either settle for average or turn over your capital to somebody who does have a knowledge advantage for management. Investing really comes down to 2 things: fundamentals and attitudes or psychology. Fundamentals is the things that will happen in the economy, the things that will happen in companies, sales, profits, etc. That's fundamentals. And then, that's what we have to think about is likely fundamental outcomes and the likely changes in psychology. If everybody knows that there's likely to be a recession within the next 24 months, then that expectation is probably already reflected in security prices. So you can't do any good by selling now. I think we're in that middle range where everybody knows that some negative events may well lie ahead. Those negative events are already anticipated in security prices, which is to say that security prices are fair, reasonable, given the outlook. When I think about the markets, I think about, are they rich, cheap, fair? If they're rich, you should turn defensive. If they're cheap, you should turn aggressive. If they're fair, steady as you go. And that's where I think we are. I think we're in that middle fair territory. Today, we have to live with Russia and the threat of nukes in Ukraine, which sounds terrible. People say, oh, it's never been this bad. But I remember when I was a kid in school, we used to have what were called shelter drills. We used to get under our desks when we were in the 4th grade and put our hands over our necks to protect ourselves from atom bombs. So that was a scary time. And people used to say, it's never been this uncertain. And we've had great uncertainties over the years. And today it feels like it's the most uncertain it's ever been, but that's because we're in new territory. We have an antagonist who seems irrational, and he has nukes. Go back to 1920. In the last 102 years, the US, for example, just an example, has had 17 recessions, 1 Great Depression, several small wars, 2 world wars, I guess 1 since 1920, lots of geopolitical uncertainty, etc. And yet, on average, over the last 102 years, the S&P 500, for example, has made over 10% a year on average. And if you invested $1 in 1920, I think you'd have $8,000 today. If there's nothing clever to do, it's a mistake to try to be clever. And most of the time in the markets, there's nothing clever to do. And that's especially true for non-professionals. The professionals rarely get it right. Non-professionals have an even lower chance of getting these timing decisions right. And that's why they should set a portfolio and leave it alone. If you aspire to higher returns, you generally have to take more risk to get them. Doesn't mean you get them, it means you have a chance of getting. Everybody should think about what is the right level of risk for them. And, for people like us, individuals, in trying to figure out what is the right level of risk, what you say is, how old am I? How many years do I have to retirement or to live? How many dependents do I have? How does my wealth compare with what I'll need to get through retirement? How does my income compare to my needs? Is my income a multiple of what I need, or am I barely making it? If I make a mistake, if I live through a down cycle, do I have time to recover from that down cycle? And then, importantly, what is my attitude toward risk? What is my level of intestinal fortitude? How will I feel living with big ups and downs? Because, if you have money to invest, one of your important goals should be to be comfortable. You should not have more risk than you can healthily endure. And this is hard stuff because there's no way to put all that stuff in a formula and come out with a risk position. And then if you come out with a risk position, there's no way to put that in a formula and come out with a portfolio. All these things have to be done judgmentally by thoughtful people. But if you think about it, you say, like I look at it myself, of retirement age, fortunately, I don't have to retire. I like my work. I have more money than I need. On the other hand, I'm a conservative person and I don't want to experience big ups and downs. And since I have more than I need, why should I take big risks to make even more? That's the kind of dialogue that people should have internally, couples should have with each other, and people should have with their advisors.